I think exit is really a really big pain point. And so, I often talk to both the investors and when we represent the targets on the company side, and I really urge parties to think about how do we, hey, this is a relationship that you're getting into that is actually more often than not intended to be marriage. You never really stay married. You're going to separate at some point. And so you need to have a very clear conversation of how and when that happens and under what terms. So, because the likelihood that you are going to exit together through an IPO, for example, is actually not how the mechanics of the deal are set up. I mean, think of just your very basic pref deal, which is the world I live in, pref equity. That's 90% of what I do. And pref equity can be very equity-like and it can be very debt-like. You'll hear me, Kristian, say, and most of my clients and have heard me say, it's an accordion. And like an accordion, it could be both equity-like and debt-like, but you can play it in all sorts of ways. As the movement comes in and out and the sound comes out, you're also playing the keys. And so there's these multiple movements that are impacting the sound that comes out. And that's why, to me, this balancing act of equity versus debt versus how that preferred is going to how what the convertible mechanics are, what the call options are, the redemption rights, mandatory, non-mandatory, all those seem like frustrating lawyer details. I hate to say it, they're not. They're the core economics.